Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Cheniere Energy Partners stock and analyzing its financial ratios. Let me know what you think. Give this video a like, subscribe, and comment below. I respond to all comments. Also, if you'd like to do a private Zoom session to discuss financials, receive a custom valuation for a stock of your choice, or support the channel, you can become a member by clicking on the link in the description below. Cheniere is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a big company, 17.3 billion market cap, so they're a large cap company. They're trading at $35.83 a share, and they have 483 million shares outstanding. To get shares outstanding, it's market cap divided by stock price gives you shares outstanding. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that back to today's dollars. And free cash flow is cash flow from operations minus capital expenditures. CapEx is property, plant, and equipment. So when you buy a factory or you buy machinery, that's CapEx. If a company has positive free cash flow, it has the ability to pay down debt, pay dividends, acquire other businesses, or invest back into the business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. And this company has negative free cash flow in 2 years, a really big negative in 2016, but they have positive in 2018 and 2019. Net income is the profit and loss on the income statement. It's revenue minus expenses. And in 2016, they had negative net income, but they had positive net income in the next 3 years. And their revenue has grown a lot. It went from 1.1 billion, then quadrupled to 4.3 billion, then jumped to 6.8 billion. They're doing a really good job at growing their company. It looks like they're doing it organically because I didn't see any goodwill on a balance sheet. So I don't think they've been acquiring any other businesses. Let me show you on their cash flow statement why they had such a big negative 2.3 billion in 2016. This is the cash flow statement, and on the top is cash flow from operations. And then you minus CapEx, which is right here, and that gives you your free cash flow. And in 2016, it was negative 2.3 billion. And if you open up operating cash flow, the way you calculate cash flow from operations, you start with net income. It was negative in 2016. And then you add back the non-cash items. So you add back depreciation and amortization and other non-cash items. And you also adjust for working capital. So if you sell on credit, you use accounts receivable, that's a cash outflow, so that hurts your cash flow. They had negative $188 million in 2016 in accounts receivables, because they sold product on credit but didn't receive the money. They will receive it in the future. When they do receive the money for the products they sold, they'll get a positive cash inflow. So in 2016, as you can see, they pretty much broke even on cash flow from operations. So they were not generating any money on their regular operational business, but they were investing heavily into their business. CapEx was 2.3 billion that year. It did decrease to 1.3 billion the next year, 800 million after that, then 1.3 billion. That's why they did a great job growing their revenue, because they were investing in their business. When you invest in your business, it's a good thing only if you grow your business. It's not a good thing if you spend all this money on factories, machinery, and equipment and your business doesn't grow. In 2019, they had net income of 1.2 billion. And I would expect free cash flow to be at least as much or higher than net income, but it went down. It was 216 million. Let me show you why. A negative that stood out in 2019 that wasn't in other years was its negative $120 million in payables. When you use accounts payable, that improves your cash flow. Accounts payable is like a loan. You receive a product or service, but you don't pay for it. You pay for it at a later time. So it looks like in prior years they had a positive cash inflow in accounts payable in 3 years, but they have to pay for it at some point. In 2019, they had a cash outflow of 120 million in accounts payable. even more so in the trailing 12 months. Also in 2019, their CapEx was high, a lot higher than 2018, 1.3 billion. So that's what brought down their free cash flow to 216 million. Let's look at the capital structure. They have $18 billion of debt, 700 million of equity, and they pay 5% interest on their debt. And they're a master limited partnership, so they don't pay taxes. To qualify, the business must receive at least 90% of its revenue from natural resources or real estate. They receive their revenue from natural resources. An MLP issues units instead of shares, so they don't have any equity in a capital structure. To calculate the equity, I just took the total assets minus total liabilities. And they're really leveraged. 96% of their capital structure is debt, which means they have 4% equity. The cost of equity is 11.6%, and we use a capital asset pricing model to figure that out. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. And they have a beta of 1.21, so the stock is a little more volatile than the market. Volatility does not mean risk. There's two types of risk. There's systematic risk and unsystematic risk. The beta is related to systematic risk. When a market moves as the result of really good news, or it moves lower as a result of really bad news, that's how the beta is affected. An individual stock can't really control market movements. So over a certain time frame, if the market went up 1%, this stock should go up about 1.2%. And if the market went down 1% over a certain time frame, this stock should go down 1.2%. You can't diversify away systematic risk. There's unsystematic risk, which are how a company performs. If a company performs really well, their stock price may go up, and if a company performs poorly, their stock price may go down. Companies can control unsystematic risk based on how they perform. The weighted average cost of capital is a blend of the cost of debt and cost of equity, and that's 5.29%. And the WACC is a discount rate companies use when they want to take on new projects. So if a new project came along that cost this company $1 million up front, but they would receive $100,000 of cash flows over the next 20 years, what they would do is they would discount those 20 years of future cash flows back to today using the weighted average cost of capital. And if those cash flows in today's dollars equaled 1.5 million, they would take on the project. Since it cost $1 million, they'd be making $500,000. But if they discounted those 20 years of cash flows back to today and it equaled $800,000, they would not take on the project. Since it cost $1 million, they'd be losing $200,000. And you only want to take on projects that add value to the company. And the WACC is a discount rate we're going to use for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 14 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $15.7 billion. We divide that by 483 million shares. And we get a calculated stock price of $32.47. They're trading at $35.83. They're trading at a 10% premium. It's a sell according to the model. Simply Wall Street has them valued at $52, so they're saying it's undervalued. They're saying it's a strong buy. Simply Wall Street uses the average analyst estimate. Since this company has been growing so much the past few years, I think analysts are expecting great growth from this company. That's why they think the stock price will go higher. I did assume significant growth in their cash flows, but I still was unable to come up with a valuation close to them. Let's see where the stock has been trading at the past few years. So it seems like the stock price has been growing little by little for about 3-4 years. It peaked in the low 40s, but did drop below 20 recently. It's come back up, but still well below its all-time high. I do think this stock is a good value, even though my model does not say so, because this company has been growing so much. The revenues have gone up so much, so I think they're in hyper growth mode and they're going to make it really big soon. Their dividend yield is over 7%. They seem to be raising their dividend periodically. It's good to understand that the stock price is not directly related to how well a company's doing. It's just a function of the stock price. The only thing that predicts the stock price is supply and demand of the market. The more people that want to buy a stock, the higher the price goes. And the more people that want to sell a stock, the lower the price goes until equilibrium is met. That's why you might see some companies that have good financials, but their stock price keeps going lower. And other companies that have bad financials, but their stock price keeps going higher. Because the market is forward thinking. So you have to try to understand market sentiment and psychology of investors. Let's look at the financial ratios. They have a good PE. The median for the market is 16.3. The average is 18.1. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 14.7. So investors are paying $14.70 for $1 of earnings. A good price to sales ratio, the median is 2.0, the average is 4.7. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 2.5. So investors are paying $2.50 for $1 of revenue. They don't have such a good price to book. The median is 2.4, the average in the market is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 24.2. So investors are paying $24.20 for $1 of book value. Equity is total assets minus total liabilities on a balance sheet. A good interest coverage ratio, the median is 4.0, the average is 13.1. Interest coverage ratio is EBIT over interest expense. I like to see above 2, they're at 2.3, so they can cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. ROE is really good. The median is 12%, the average is 14%. ROE is net income over equity. I like to see above 20%. They're at 164%. The main reason is because they have such little equity in a capital structure. They're mostly debt, so it makes this ratio look really good. They have a high current ratio. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 2.8, so they can easily cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios is to compare them to similar companies. I've done videos on 24 oil and gas midstream companies, and Cheniere is right here. And if Cheniere has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are worse in PE. They're a little worse in price to sales, a lot worse in price to book. They have a high current ratio. They have the highest ROE of all the companies. In terms of debt, they're doing pretty bad, 96% debt. The average is 59%. They're a big company, 17 billion market cap, which is bigger than average of 10.8 billion. They have a 7.2% dividend yield, which is much lower than average. So to summarize, I do have them trading at a 10% premium. Their ratios look okay, and their financials look really good because they're growing at a really rapid pace. So I think they're going to be one of the biggest players in this market. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, discuss financials, receive a custom valuation for a stock of your choice, or support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.